and welcome back to TVP. This week we have value investing heavyweight Mohnish Pabrai joining us. Mohnish is the founder and CIO of Pabrai Funds, the founder of the Dakshana Foundation, a close friend of Warren Buffett, and a frequent bridge opponent of Charlie Munger. He joins Juan and Andy Evans on this episode to discuss how Mohnish's dad's entrepreneurial experience shaped his understanding of risk, his commitment to leave as a pauper by giving everything away to charity through Dakshana and following the great example of Chou Feeney, the rationale behind cloning as a strategy, why he never went for the insurance model, and concentration in ergodicity. Finally, you will note some variety in the audio quality this episode. The joy of having guests join us from across the world also means that we're at the mercy of some fickle tech, but we hope that it doesn't disrupt your experience too much. Thanks for bearing with us and enjoy.
Mohnish Pabrai, welcome to the Value Perspective podcast. It's a pleasure to have you here. How are you?
It's wonderful to be here, and thank you for having me. It's excellent.
Where do we find you today?
I'm at my home office in Austin, Texas.
That's very nice. Mohnish.
What about you guys? Where are you at?
Well, we are at the very amazing Schroders recording studio at the moment, enjoying this conversation with you. If you are a value investor, it would be very difficult that person has not heard about you. But for those that might not know you, could you please provide them with a brief summary and introduction about yourself?
Sure. I always tell people who are introducing me that the thing that they should not skip in the introduction is that something I'm very proud of is I got a lifetime ban at a casino in Vegas who basically told me I could never play blackjack at their casino. And I told them, I'm not counting cards, because normally you ban people who are counting cards. And they said, it took us about 6 months to figure it out. And we agree you're not counting cards, but we cannot win against your system. So I asked them if they would give me a letter, like a graduation certificate. And they said, no, you're just banned. That's that. So anyway, I've been a student of Buffett and Munger and Graham now for almost 30 years. I heard about Warren Buffett for the first time in 1994, and it opened up a big new world for me. I had never actually bought a stock before that, never really worked in the industry. And I was really intrigued and fascinated as I read the first few biographies that had come out on Buffett, and then the Berkshire letters, and then the Buffett partnership letters, and, just opened up a whole new world for me. And basically, I just kept reading and learning and started to invest following that approach in 94. And about 5 years later, I had some friends who asked me to manage money formally for them. A small amount, 8 guys, a total of $1 million. And that's what led to the formation of Pabrai Funds. I didn't plan at that time for it to become a full-time vocation. I thought it'd be just something on the side for me and my friends. I manage about 900 million now. It's mostly high net worth families. And the funds have been around for about 24 years. And over the years, surprisingly, Warren and Charlie both became friends, which was not expected. We always think of them as, icons, never to be touched or met or interacted with. And so that was interesting. I used to play quite a bit of bridge with Charlie on Fridays at the LA Country Club, which he doesn't do now because he's not so mobile. So that's kind of a quick backdrop.
And before we get into the world of probabilities and kind of asking you about investing, we came across your Dakshana Foundation, if I've pronounced that correctly. Can you tell us a little bit about that before we go into the rest of the interview?
Oh, sure. Yeah. So just yesterday, there was news in the New York Times that Chou Feeney had passed away. And I don't know if you guys are familiar with Chou Feeney, but there's a book called The Billionaire Who Wasn't. And it's a great book to read. And Chou Feeney, I think over his lifetime, gave away about $8 billion or more to charity. He tried to do it anonymously. He actually went to great lengths to make sure sometimes that the recipients didn't know who the person giving the money was. And his objective was to die with zero. And so he was 92 when he passed away. And I think a few years back, maybe 3 or 4 years back, he moved into a simple rental apartment in San Francisco. And he was down to, I think, his last 2 million. And I think he pretty much accomplished what he sought to do, which is to die with zero. And that is what I'm trying to do, live up to the Chuck Feeney standard, die with zero. And I'm going to be leaving planet Earth on June 11th, 2054, about 30 odd years from now, 30 years and a few months. And one day before that, which is June 10th, 2054, I hope to be down to $100. So there is one engine which is compounding assets and increasing wealth. And there's another engine, Dakshana, which is focused on giving it away. And I started Dakshana about 17 years ago, basically because I knew that, trying to start this when I was 70 or 80 years old, I wouldn't have much energy to do anything. So we started small about 17 years ago. And the idea was to become good at giving money away. Giving money away is far more difficult, giving it away effectively is far more difficult than making money. And so Dakshana basically, amazingly, has done far better than I expected. It's been very effective at the giving. And basically, we identify very poor but brilliant kids in India who come from families which are typically making well under $100 a month, $3-4 a day or less. Some of them are $2 a day. And we basically take over their education for about 2 years, from 16 to 18. And we get them to the IITs, which are like the MIT of India, or AIMS, which is like the Harvard Medical School of India. And it does a full reset for the family and the community because their income levels go to world standards at that point. And currently, Dakshana is spending about 3 odd million a year. And the objective is, and we just started a program about 13 million of CapEx in the next 3 years to increase our capacity. But the idea would be that hopefully if the compounding engine works in the next 3 decades, then the giving engine needs to work even better, because as we compound money, then I need to amp it up like Mr. Feeney. So that's what Dakshana is all about. Basically, I like to play games. I like to play blackjack. Dakshana is a game. Pabrai Funds is a game. Bridge is a game. I just like to play games.
That's really nice. You've mentioned in the past that, and you will correct me if I'm wrong, when you were growing up, your dad was an entrepreneur, and you would see him many times start new businesses and those businesses not doing very well, and then he would start all over again. And so we thought that it would be nice to start our conversation by framing how did that experience shape risk for you?
That's a great question. Actually, my dad was exceptional at identifying offering gaps in the market. He was really good at kind of looking at kind of what was going on around him and saying, oh, this product or this service doesn't exist. And I know that if I create this product or service, it's likely to do well. And so his hit rate on those was extremely high. So usually when he had a startup, and in India, there was no ecosystem of venture capital or anything, or even bank financing for that matter, he repeatedly started with zero. And he was almost always right about the opportunity. I think he was very good at identifying those gaps that existed. The issue he had was that he was an eternal optimist and he was in a hurry. So once the business got going, he would want to grow it as fast as possible. And so these businesses typically had a very thin layer of equity and capital and as much leverage and debt as the banks would give him. And he was just constantly maxing on the leverage to grow as quickly as possible. And the moment the first headwinds would show up, and there would always be headwinds, we always have headwinds in business. these businesses just were not built to withstand even the lightest winds because they were just always levered to the hilt. And they would invariably crumble and fail because the ecosystem also was not there that you could get other financing or someone to give you equity or something like that. And so he would go back to square one. And amazingly, he would, in a few months, concoct up a new idea and get going again. And I saw him do this repeatedly. And he was a very logical engineer, kind of rational thinker. And I remember that one time when I was about 10 years old, there used to be this kind of astrologer who used to come to our home on Sunday. And this guy's, wearing like orange robes and has all these marks on his forehead. And my father would sit with him and ask him to tell him about the future. Okay. And the astrologer would give my father various data points of what was going to happen and so on. And then next Sunday, the astrologer would be back. So I mustered up the courage to go up to my dad and said, you got to know that this guy is full of shit, that he doesn't know nothing. And we don't have money and everything's like gone. And you give him money every week and then he shows up the following week. Why would you want to do this? And he said that when I give him money and I ask him about the future, he gives me a very rosy forecast for what's about to happen next in my life. And I suspend reality when he's talking to me like that. And he is the rope. He said, I'm at the bottom of a very deep well, and I need a rope to come out of that well. And he is my rope because he tells me these stories about these new businesses that I'm going to create and that they're going to prosper and that things are going to be great. And that is my rope to come out of that well, not be depressed, and go start the next business. So that was the experience. The impact it had on me was that I was lucky that my dad was doing really well when it came time for my brother and I to go to college. And he wanted us to come to the US for college. And thankfully, he could afford it at that time. So we came to the US and I studied engineering. And my plan was to never, ever be an entrepreneur and to never, ever start any business because I'd seen these huge gyrations up and down. And I just didn't want that. And I said, okay, if I get a good engineering degree, I'm going to get a good job. And I'm always going to be able to have a job. And life is going to be stable. 15% is going to go into my retirement account, into index funds. And that's going to grow and all of that. And my dad was visiting me, I think about 3 years after I started working. And he told me that he was disappointed, that he had all these aspirations of what I might do. And here I was, doing some nondescript cog in a wheel of a large company kind of thing. And I told him, do you remember my childhood? And do you remember the trauma? He said, oh, life just, that was all excitement in life. We can't have a boring life. Mm-hmm. And so he was able to prevail on me and I basically left my job and started my first business. And then went from there.
It's a great story. We've read the book Richer, Wiser, Happier by William Green, and you're profiled in there. And the main thing around your profile is about cloning and how you've really made your career out of being a great cloner. Can you talk us a little bit through what you were doing when you were cloning and who the people of your cloning or the subjects of your cloning were?
Yeah, I mean, I think, Charlie Munger talks about these mental models. And I think cloning is a very powerful mental model. One of the weird, unusual things about humans, and I still don't know why this is the case with humans, is most humans have a strong aversion to cloning. I'm not sure where that comes from in evolution, but they think it's beneath them. They almost think it's like copying or something like that. Also, a lot of humans will believe that, Starbucks is such a great idea, but it's already been done. Or, Soul Cycle is a great idea, but it's been done. And actually, there's room for many Starbucks. And there's room for many versions of the same business. And that's the other thing, that humans have a false mental model where they see that someone has done something innovative and they think that it's done. There's no opportunity there. And we run into some humans, like, for example, if you look at a company like Microsoft, they spend so many billions of dollars a year on R&D. They've got Microsoft Research, which in several decades, more than 4 decades, have produced nothing. They just keep having these very smart PhDs funded and all of that. Nothing comes out of that lab. But what has worked for Microsoft is they saw WordPerfect and they cloned it and created Word. They saw Lotus 123 and created Excel. They saw Netscape and, created Microsoft Explorer. And now Edge, search, they created Bing. And you know what Bing stands for is, but it's not Google, And so all the successes Microsoft has had has come from being an intense cloner. So Apple invented the mouse. Actually, Apple copied the mouse from Xerox PARC Labs. That's where they copied it from. And Microsoft wanted to make the mouse work in a MS-DOS and Windows world, which was a big challenge because of the very different architecture. And they were just dogged about it. Finally, the engineers were able to do it, and they created Windows. And Microsoft's not even a great cloner. Windows took like 15, 20 versions before humans could actually use it. And they still complain. It's not as good as that, So even not being that great a cloner gives you a huge advantage. Sam Walton with Walmart, I think for the first 15 years or 20 years of Walmart's existence, there was absolutely nothing new that Walmart came up with. It was a completely cloned model taken from Kmart, taken from Sears. And Sam Walton spent an incredible amount of time in his competitor stores. So whenever he was traveling anywhere to see any Walmart or scout new locations, he was always going into the retail stores of even small, mom and pop competitors. And he didn't care if they were big or small or successful or not successful. Even a failing retailer, he would find something that they were doing that he could copy from them. And Walmart got built on that. So even a company like Starbucks, Howard Schultz looks at the cafes in Italy and says, this can play in Peoria, Illinois, and clones it, and it does play. And then he's gone now upscale with, Starbucks Reserve and all of that. So I think what I've found over the decades is that, number one, most humans, for whatever reason, think cloning is beneath them. And number two, that if you don't follow that model, it's going to give you a huge leg up in life. And Dakshana is a cloned model. I found a guy who was doing something really smart. I actually wanted to fund him. He didn't want to scale. So then I asked him, do you mind if we copy your model? He said, no, I would actually help you, And so Pabrai Funds was cloned from the Buffett partnerships. So the Buffett partnerships had these unusual rules from 56 to 1970 they ran, and he had the greatest record and all of that. And when I was starting Pabrai Funds in 99, this is 3 decades after Buffett has shut down. And in 3 decades after he shut down what is arguably the most successful hedge fund ever, no one had cloned his model. No one had cloned his fee structure. Nobody wanted to do it that way. And I was surprised. I said, wow. And I said, well, don't be surprised, Mohnish. This is the way humans are. They want to leave all these opportunities for you because they don't want to clone. And I have so many investors who will not invest in a fund which charges a 1 or 2% management fee. We charge no management fee, and I didn't come up with that. I copied that from Warren. And so you latch onto a demographic that wants that. They want the aligned interest of the investment manager, and it works. So I have found in the investments that I've done well with, many of those have been cloned. The business models have been cloned. The charity has been cloned. I mean, I have no original ideas. I'm just the shameless cloner.
I guess I've got a follow up to that. So if I think about cloning, can you ever get to the point where there are too many cloners? Let's take Berkshire Hathaway, for example. So back in 1979, there were 20 people or 20 potential cloners sat there listening to Charlie and to Warren. And then in 2015, there's 44,000 potential cloners. Does it ever get too competitive, or actually is it quite a difficult thing to do? So not everyone can be successful as you have with cloning for whatever reason.
Well, what I'm saying is that now the Berkshire annual meetings are, online. Millions of people listen to those. All the past meetings are online on buffett.cnbc.com. So it's been in the public domain for a long time. How many companies do we have that have cloned the Berkshire mark? Almost zero. Basically, because I think the thing is that cloning doesn't work unless you are fanatical about it. So you need Sam Walton was a fanatic, Bill Gates is a fanatic. And so it's the fanatics who can make this happen, not the people who say, I think this is going to work and let me give this a go at it. And if you have that type of an approach, you got to go all in, And so, again, for whatever reason, very few humans are willing to go all in. So it's the intensity of the pursuit. So I am not really concerned that cloning is going to stop working because the cat's out of the bag or something, or because I'm doing this podcast or whatever. It's going to be alive and well because humans just, large number have aversion to it. The ones who don't have aversion are not fanatical about it. And the other piece is that there are so many areas available for cloning. So even if one particular area becomes somewhat competitive, you have so much other greenfield areas you can go into.
Mohnish, you will correct us if we are wrong. When you started your career with the very big influence of Warren and Charlie, and I think that this even comes across on your first book, The Damned Investor, you were more leaning towards the Benjamin Graham side of value investing. But as your career has progressed, you seem to have leaned more towards the way that Charlie and Warren think about the world. Is your perception of risk changed because you have become more experienced, or because it has been influenced by the way that they look at the world?
Yeah, I think the Ben Graham framework is like bedrock. I think that all of us need that bedrock. So the idea that the stock is not a piece of paper, it's a ownership stake in a business, the concept of margin of safety, and so those ideas permeate across, whether you're doing pure Grahamian investing or you go with the Buffett or Munger approach of the great businesses and so on. They all use this underlying bedrock. The reality of the situation is that we will make a lot more money by having ownership stakes in businesses that grow dramatically in value over time. So if I bought a business for 40 cents on the dollar and that dollar never grew, or it grew at a low rate, I might make 2 or 3 times more. But if I even paid 60 or 70 cents on the dollar for a business that was growing, 10, 15, 20% a year, and I didn't pay that much of a premium for that, clearly that's going to be a vastly superior approach, not to mention far more tax efficient, because you're not, each time paying Uncle Sam when you sell and want to look for buying again. And the other piece of it is that there are only so many great ideas one is going to find over a lifetime. And so the I think the idea that Ben Graham had, that is that you sell a business when it gets at or near its perceived intrinsic value, is at odds with the theories of Phil Fisher, for example, whose perspective was that a great business may surprise you about its real intrinsic value. Intrinsic value is a very difficult thing to figure out for most businesses. So the odds that you may be wrong about an assessment of intrinsic value can be extremely expensive. And so the model of giving a great business a lot of rope, which is holding it beyond the point at which you think it has passed its intrinsic value, would be blasphemy in the world of Ben Graham. But I think that approach is extremely important for true wealth creation over long periods. Ben Graham himself made most of his money from owning one particular business for many decades, which was GEICO. And so the GEICO ownership actually violated the core principles that he was espousing and teaching. He just felt like he couldn't teach the approach to find or hold a GEICO as easily as he could teach a quantitative approach to investing. So even in Graham's case, half his net worth when he passed away was GEICO, and it had trounced the S&P by 7-8% a year over the long holding period. So I think that I think that a Swiss Army knife approach to investing is probably best, where there are times that we're going to find anomalies, not grow that much, but is really cheap and it's very stable, could give us a great return for some time when we don't have a great business that's obvious to buy. So kind of to while our time, if you will. But I think that if we are in the fortunate situation of finding a great business that with a great runway, then we want to hold on to those for dear life. And this is a big mistake I made for many years, where I was buying well below intrinsic value and selling right at intrinsic value. And I think it was a mistake.
Mohnish, you brought up GEICO there, and obviously that takes us on to the subject of insurance. One element of the Berkshire model is obviously insurance and having some insurance to have a flow to invest. I think that at one point in time you did have an insurance company, but you chose not to take that on in terms of copying the Berkshire model. Can you talk a little bit more about owning an insurance company and why you didn't decide to take that on?
Yeah, I think that's a good question. So Warren has repeatedly said that insurance is a commodity business. It's very difficult there are some pockets within the large insurance industry where one can have a sustainable competitive advantage. But by and large, the bulk of the industry operates in a commodity-like manner. If I'm a small business and I'm looking for workers' compensation insurance, for example, I'm going to take the low bid. I may take the low bid amongst A-rated carriers or B-plus rated carriers. But once a carrier or insurance company is A-rated, the lowest price wins. And so most insurance companies do not have pricing power. And Warren has also said that the average insurance company is a terrible business. And what I realized almost right after I made the acquisition of Stone Trust Insurance is that I think at the first board meeting, it was becoming clear to me that this is not the place I want to be. It was a very commodity business. They were a price taker, and their dumbest competitor was setting price. And so I felt that rather than go deeper and deeper, getting more and more pregnant with this situation, I wanted to put the toothpaste back in the tube, so to speak, which is not always easy to do. Toothpaste is only designed to come out of the tube, not go back in. So I basically decided I'm going to reverse a course. And we decided to sell the insurance company. And we were able to sell it for just about what we bought it for, which I thought was a very good outcome. And we were able to return most of the capital that we had raised back to the investors. The person who bought the insurance company from me is extremely happy with Stone Trust. And the difference is that he's a vastly superior operator than I am. And I remember that when we sold the company to him many years ago, the premiums we were collecting every year were about $65 million a year. That company today, after all these years, it's been 7 or 8 years since we sold the business, maybe six or 7 years. The premiums last year were $50 million. It's down 30%, but the combined ratio of that business is 62%, unheard of in the insurance business. And so Francis Chou, who bought the business for me, is a unbelievably great operator. I mean, he's got decades of experience. I would never have been able to do what he did. So actually, it was a win-win for everyone. It gave Francis a platform to build the insurance side. And so, the interesting thing I learned, and, this goes back to the concept of, the great businesses and then the mistakes in investing and all of that, is investing is a very forgiving business. Even the best investor probably not going to be right more than half the time, right? You're going to have 50% error rate is just par for the course. And so I realized that when we had bought the insurance company, that this was a mistake. And so I said, okay, can we reverse? Because it's going to consume a lot of brain cells in an activity that I don't want to really particularly be focusing on using brain cells on. And so that's what ended up happening. And I learned quite a bit. I'm very grateful for the experience. I think being able to see the insurance company from the inside, they were very good people, and to be able to see the claims at an individual claim level and, kind of seeing how the sausage is made, if you will, it has been a great experience for me. It taught me a lot, and that I'm sure can only help in the future. Even in the case of Berkshire Hathaway, Charlie Munger said a few years back that in the very distant future, insurance may be a small business at Berkshire. It would not surprise me that if and when Ajit Jain is no longer running things, that they may elect to run off that business. Because I haven't heard of them having a second Ajit. And a lot of that business only works because there's Ajit. Just like Stone Trust only works because there's Francis Chou. So these unusual insurance operators are very rare.
Can I ask on that?
I think it's a difficult field.
Was there any scope, if Francis was fantastic on the underwriting side, was there any chance for you to partner and you be on the investment side and he be on the insurance side in a similar way that they have at Berkshire?
Well, we are old too soon and wise too late. When Francis was buying the business from me, he begged me to keep a stake. He said, Mohnish, I really want you to keep 20%, 25%, whatever you want. And he said, let's do this together. And because I had seen this business up close, and I probably underestimated what Francis was all about, if he made that offer to me again, I would take it. Okay. But at the time, and he actually repeatedly kept asking me, because there were earnouts we had to, we had our future payments were based on how the business performed. And each time he was making an earnout payment to us because the business performed extremely well, he again asked me, do you want to roll this into a stake? And I kept saying no. Yeah. So, I think that Francis is a exceptional underwriter and operator. And I think he's a good investor. But I think he's an example of a guy who's always stayed with Graham. He's a classic Graham investor. And yeah, I think that a situation where Francis is the operator on the insurance side and someone like me is on the investment side, I think it would do even better. I think it would do very well. That'd be a good marriage. And part of the reason it'd be a good marriage is because he's such a great guy. So I think in terms of chemistry, in terms of trust and chemistry and competence, I think we would have a lot of fun with that.
I would have
Who
thought...
knows? We're both young. It might happen at some point. We'll see.
I would have thought that the reason why you, at the time, thought that it wasn't going to work out was more related to how regulation has changed over the decades that might limit your capacity to make that a great business in the way that they were able to do it with Berkshire. Is that a misunderstanding?
Well, Berkshire has some very subtle aspects of its insurance business that are not available to most other insurance companies. So Nebraska, insurance is regulated by state in the US. The regulatory framework for insurers based in Nebraska is vastly superior to most other states. One of the things I had almost finished doing before Francis had bought the business is I had re-domiciled. We had started the effort to re-domicile the business in Nebraska, because I realized once I was in the business and I looked at the different state laws that it was an advantage to be domiciled in Nebraska. Even if you were not writing a lot of business in Nebraska, there are reciprocal arrangements that the different states have, which give a Nebraska insurer some advantage. I don't know whether that advantage came about because Warren was able to work with the regulators to change some of the frameworks over the years. So the first is that the state of Nebraska has a better regime for insurers who are really good at the investing side. The second big advantage that Berkshire has, which people don't understand, is the insurance companies Berkshire has are heavily overcapitalized. So if a regulator says that if you're writing $100 of premium, I want to see $100 of equity. In many cases in those businesses, Berkshire has $500 of equity. And when you have $500 equity and you're writing $100 of premium, this is the same situation that now Francis finds himself in at Stone Trust, because their premium volumes have dropped so much and their surplus has increased so much. The regulator is going to give you a lot of leeway. So to give you an example, when Berkshire bought the Burlington Northern Railroad, normally just at the highest level, what regulators want in terms of an insurance framework is they want the float invested very conservatively into fixed income, because that's going to be used to pay people in the future. And they don't have a problem with the surplus being invested in equities, because that's kind of the backup, right, for the insurance. In the case of Berkshire, the regulators in Nebraska have given them the freedom to even invest the float in equities. And when Berkshire went to them and said, look, we're going to buy this railroad, and this railroad, you need to think about it like a bond. So if you think about the way the railroad operates and look at the long history of the railroad, it's producing $5 to $10 billion a year in cash flow. So it's a bond with a variable. And we're going to put this railroad inside the insurance company. And when you think about the way the float is allocated and the surplus is allocated, please think of the railroad portion being part of the float. And the Nebraska regulators accepted that. And what happened is that they paid about $40 billion or so for the railroad. If they were to sell the railroad today, my guess is it would sell for something north of 120 or 130 billion. Its value has more than tripled, excluding all the huge dividends it's paid out over the years. And now the Nebraska regulators absolutely love the whole railroad sitting inside, because they can see the value compared to the publicly traded railroads. And just recently, interestingly, just in the last few weeks, Berkshire did a filing where they showed that they have moved the railroad out of the insurance company. And I know that would have been a fun conversation with the regulator, because the regulator said, no, we like the insurer. Like the railroad. And Berkshire would have said, well, look, I got $700 of equity for $100 of premium. I'm still going to be $400 of equity for $100 of premium. It's still like 4 times what anyone else has. Do you have any concern? And one of the things that Buffett did a long time ago, in the 80s, they had a lot of trouble with some insurance operations. I mean, some of these things were really horrendous, 130% combined ratios, 140% combined ratio. They were upside down. These companies were eventually liquidated. They did really terribly. They could never fix them. They liquidated them. But what Berkshire did at the time when they liquidated these companies is that the parent company stood behind the claims, which they didn't need to do. So even though they had no obligation, so these companies were in real trouble, horrendous combined ratios, they were going to be liquidated. Their business model didn't work. And Berkshire, at the parent level, did not have an obligation to pay off all claims. It was non-recourse. So the claims were only to be paid to the extent that those companies had capital. But those companies ran out of capital. And what Berkshire at the parent company did is they stood behind those claims and they paid every single one of them. And so the regulators basically believe that in the case of Berkshire, there is an implicit guarantee on these claims. It's not an explicit guarantee, it's an implicit guarantee. Kind of like Freddie Mac and Fannie Mae, being an implicit guarantee of the US government. And so the regulators will always look very favorably upon Berkshire Hathaway because of that history. And so other insurance companies do not have that type of a reputation with the regulators.
That's really interesting. I'm going to change topics a little bit here. You have clearly been gifted with a mind that is very well suited for math and thinking in terms of probabilities. And that probably has helped your career in the way that you've made decisions over time. For those that don't have that inclination or that have been educated to think in probabilities, what would be the best way for that person to learn to adopt probabilistic thinking?
Well, I think probabilistic thinking is very important for investing because everything is probabilities. Being a good bridge player is a great way to build that probability muscle. So you can have fun. Bridge is a very fun game. It's a very easy game to learn. I would say it probably won't take more than 30 minutes to learn the game. And one cannot master it even in a lifetime. So it's a great game to continuously keep learning. But I think that Buffett and Munger have gained a lot from playing games like bridge. I came to playing bridge separately from investing. I actually was playing bridge many years before I became an investor. So it was a coincidence for me that I was playing and loved bridge. But I think that can really help the probabilistic thinking. And I think even when one is studying businesses and studying histories of businesses and trying to extrapolate what they're going to go and where they're going to be, one is going to see a range of outcomes. That's just the nature of the way the world works. And so if one is just good at that type of thinking, which games like bridge or blackjack can give you, then you're that much ahead.
Mohnish, you famously run very concentrated funds. If we can go back to the topic that we started with, which was around risk, how do you arrive at that decision to run with those concentrated funds?
Yeah, well, if you study the subject, the amount of benefit you get in terms of diversification and reduction of risk starts to go down really quickly as you add more positions. So obviously, if you had a single stock portfolio, that's at the extreme end of the risk curve. But once you're at about 4 or 5 positions in different industries, you're already quite diversified. Once you take that number up to 10, that's a significant, well-diversified portfolio. But when you take it from 10 to 20 or 30 or 50, now you're hurting yourself because the minimal benefits you would get from diversification would be more than offset with the lack of knowledge of those businesses. So when we when we stay very narrow, we are basically going to be at the epicenter of our circle of competence. We understand those businesses really well. As you start layering on more things and more companies, there's going to be a variance in terms of how well you know the businesses. And not knowing the businesses well enough, even in a highly diversified portfolio, is risky. So from my point of view, once we get past a few names, the risk profile really does go down.
There, which is one thing which has come up on the podcast a number of times, is the idea of ergodicity, the idea that there's a difference between your time-weighted returns and just an ensemble average. And so that has implications for the chance of ruin over time. So something which is on an expected value basis looks like a good trade to make. If there's a chance of ruin, then obviously that may not be as appealing as you think. And if you run with a concentrated number of holdings in your portfolio, there's obviously an increased risk that you have that chance of ruin. So how have you thought about that risk and managing that risk through your concentrated portfolios?
Yeah, so, any number multiplied by zero, no matter how big, is zero. So we obviously don't want to go there. It is in the nature of equity investing that a few of the decisions that you're going to make are going to generate outsized returns. And so, for example, if I were to look at, let's say, the Walton family owning stock in Walmart, they, Sam Walton, during his lifetime when Walmart was not very valuable, he distributed the stock to his kids and all of that. And he passed away. There have been no Waltons running the business for several decades. There might be one Walton on the board, but I'm not even sure if that's true anymore. But they've all held the stock. And they've held the stock, and it probably makes up 90-95% of their total assets. So, when you look at it from the outside, you'd say, oh, this is terrible, so non-diversified, etc. They probably know Walmart better than anything else. And from their point of view, so I think that if we step away from the public market for a second and we look at founders who create a lot of wealth with successful businesses, by definition, the overwhelming majority of them are not diversified. In many cases, the companies may not even be public. So, they may have 90-95% or more of their net worth in a single stock. Even when the company is public, they may have a significant portion in a single stock. So, and of course, they can be hurt. And we have plenty of cases where they can be hurt. But the other side of the coin, which is that great investment opportunities are rare. And when you find yourself in the happy position of owning a great business and it's not overpriced, etc., I mean, that's like, really a big sin if you start trimming because, it's more than 25% of the pie. I faced this issue in real time. We invested in a business in Turkey, Reysas, which was around 3% of liquidation value when we invested. I think the market cap was around 20 million or so. Liquidation value was like 600 to 800 million. And of course, it was a no-brainer investment. And I was surprised we were able to get a lot of stock. So we ended up getting about a third of the company for about $8 million. Reysas now is valued at about 500 or 600 million. And it used to be, I think until a few weeks ago, it used to be close to 800 million. But the value of the business today is even higher because they've done a few things in the last few years. So liquidation value of that business is well beyond $1 billion. And if I look at intrinsic value and not liquidation value, it goes well beyond that. And so it makes up a significant portion of some of our funds. Every quarter when I write to my investors, I let them know we've got this issue. And I let them know, listen, if you're uncomfortable, you should get off the bus because we're not going to lighten up. And I can't really justify lightening up Reysas when it's undervalued, when it has great management, a lot of great tailwinds. And yeah, that comes with risk, but we're not going to find, a Reysas every 2 years. That's just not going to happen. So anything I replace it with, first of all, there's going to be a big tax bill, but then anything I replace with is likely to be inferior. And the other thing that has happened is in the last 4 odd years of owning it, we've gotten to know the business a lot better than we knew before we invested. And so even though I'm not a founder or a person in management of Reysas, I think of it like a business my family owns. And if there's a business like Walmart that your family owns, it's probably not the best decision to start looking at, okay, let me diversify and this and that. So it is a double-edged sword. It does come with risks. But also, one of the things about investing is that if I look at my friend Nick Sleep in the UK, and Nick basically was very early in investing in Amazon, and Amazon became a big part of the portfolio for him, and the UK regulators were giving him some grief about that. And he and his partner looked at each other and said, look, we have hundreds of millions of dollars each. We never thought we'd have this, or even anything close to this. And why should we let other people tell us what to do? So what if we just returned everyone's money? We just manage our own money. And then whatever Amazon becomes is nobody's business, whatever percentage of the portfolio. And Nick returns everyone's money. And basically, I think at the time he returned the money, he put everything in 3 stocks, right? So he put a third into Berkshire, a third into Costco, and a third into Amazon. And of course, what happened is Amazon kept going. The Energizer Bunny, it never stops. And it again became a very large portion of the portfolio that he personally was running. It became more than 50, 60% of the pie. And at that point, he himself got a little antsy about that and sold off half the Amazon position and bought a company called ASOS, also in the UK, which between us girls is not a good business. It will never be a good business. From my perspective, I think it's a mistake for Nick to be invested in ASOS. And that's a greater risk than a business like Amazon going to zero. If I really look at a business like Amazon, it's really multiple businesses. It's not a single business. And if you look at someone like Jeff Bezos, what percentage of his net worth is in Amazon, or Andrew Jassy, and so on. So my perspective, if I were to critique that, be so bold as to critique that with Nick, is he had a very well-diversified portfolio with those 3 stocks. Each one of those 3 companies is exceptional. And even if one of the 3 survived, he wouldn't be in the poorhouse. He would still be fine. So my perspective, if I were him, would be that, just leave them all alone. Let them all be. And if Amazon becomes 80%, so be it. That's okay. That's a good thing.
It's really interesting. Thank you very much.
Mohnish, given the levels of concentration that you feel comfortable running, as per what you just explained, wouldn't it be better for you to run a vehicle with permanent capital rather than the current structure that you have?
Yeah, I think eventually what happens with all of us, if we become very successful, is the vehicles eventually become permanent. So if I look at Nick Sleep again, it's a permanent vehicle because it's his own money now. And the same thing happened in many ways to Warren Buffett with Berkshire Hathaway. He was such a large portion of the pie. And I'm not particularly concerned about this. I don't get a lot of sleepless nights thinking about, permanent versus non-permanent capital. I think that at the back of my mind, I always feel that, okay, if everybody took all the capital away, right, I still have a decent amount of my own capital. And if I never, ever managed anyone else's money, I would still have a happy existence. So it is possible at some point I could involuntarily be turned into a permanent capital vehicle. And if that happened, such is life, no problem. I think that if the investors choose not to have the confidence in having some of their hard-earned assets with you, it's a choice they have and they can continue with their choice, and that's perfectly okay. So I don't see a big compelling need or reason to change things from the way I'm doing things right now. I like the families that I that have invested with me. I like most of our assets are first generation entrepreneurs who are still building wealth. A few of them have retired and such, but it's a great mix. So if that mix continues for a while, that's okay. And if it comes to an end, it will not be the end of the world. Either way is fine.
If I may ask a follow-up question on the Turkish example that you provided before, when you are investing outside of the US in places like emerging markets, you are running a risk, which is not only the business risk itself, but also you are exposed to the currency. And Turkey has been going through a rough time over the course of the last, I would say, 2 to 3 years. How do you think about that in the context of what you were explaining and the subject of ergodicity?
In fact, Reysas is a really good example to study that from a currency point of view. Before we made the investment, I fully expected that the Turkish lira would get decimated. I expected absolute clobbering of the lira. And it had no impact on the investment decision because I said, if I have a warehouse in a prime location in Istanbul with a long-term inflation index lease with Amazon or Carrefour or IKEA, that has a global value and that value will prevail. So cement has a global value and steel has a global value and prime real estate in a place like Istanbul has a global value. So my take was that even in extreme scenarios of currency decimation, we should be okay. And in reality, what happened is that when we invested in Reysas, it was 5 lira to the dollar. Today, it is more than 28 lira to the dollar. So 80+% devaluation. In dollars, we are up, 20, 30x. And in lira, we are up infinite X, but who cares about that? And then there are 2 other investments I made in Turkey. One was a Coke bottler, and the other was an airport operator. In both those cases, in the case of the airport operator, it was very simple because all of their revenues are contractually in euros. Very little of TAB Airport's revenue is in local lira. Their expenses, a lot of the expenses, staff salaries, etc., are in lira. So actually, in that case, a decimating currency would give them tailwinds because their costs would go down while their revenues would stay intact, which is exactly what has happened. And one of the things that markets do is they stereotype and they use broad brushstrokes. And Turkey was considered uninvestable. It was considered, very investor unfriendly. And, obviously any place you go to where the currency has a problem, most investments aren't going to work well. So what I noticed is that the baby got thrown out of the bathwater. And when I sifted through, I think I met with maybe 60 or 70 listed Turkish businesses over the last few years. Most of those companies are not investable. I think they would face real headwinds in this environment. But there were a few that the baby got thrown out irrationally. And that's what we're looking for. We're looking for irrational behavior amongst market participants. And so I'm not so concerned about overweighting risk of emerging markets or overweighting risk of currencies. I think what one needs to be a rational investor and accurately weigh those risks, not be paranoid about those situations. In the case of the Coke bottler, something like 70% of their revenue is not even from Turkey. It's coming from, a dozen other countries. And the same with TAB Airports. Even though their currency is euros, a large portion of revenues are coming from outside Turkey. So that was actually excellent because now it's a business listed in Istanbul facing all the negative perceptions of investors, leading to ridiculous undervaluation and irrational undervaluation. And then the second thing, what I noticed is that these 3 businesses, each one of them had off the charts management, off the charts owners, and just incredible capital allocation, better than what I would find in a lot of developed markets. The quality of the people was extremely high. The competence of the people was very high. The integrity of the people was very high. So I think a rational investor should weigh all of these factors in making a decision. I have a lot of comfort in the investment we made. And the funny thing is that in the last 4 years, the clouds over Turkey have not lifted. There's still a lot of big clouds over Turkey. It didn't stop Reysas from going up 20x in dollars. Didn't stop it. Still got there somehow. I don't know how it got there, but somehow it got there. So that's kind of how I think about it.
Thanks very much, Mohnish. I can see from your background, and for listeners who can't see it, you've got a wonderful library behind you. And our signature question we ask all our guests is whether you've got a book recommendation. So I've got high hopes for your book recommendation.
Yeah, I think the book I read this year that I really enjoyed a lot is the title is What I Learned About Investing from Darwin. And it's written by this guy in Singapore, Polak Prasad. His last name is Prasad. It's an exceptionally well-written book. He's an exceptional investor. I actually read it twice, because I just enjoyed it so much and I felt like maybe I missed a few things. But Polak, he's got a good sense of humor. So I think it's a page turner. It'll keep you occupied. And I think some tremendous lessons. And I mean, I made some changes to the way I invest after reading the book, which is, if I can make even an iota of a change after reading a book, that's a huge home run. And so there was a lot of take-home value. So I recommend that.
What sort of changes did you make to your process after this long that a book had such influence in you?
So one of the things like Polak brought up, he said that, the investments he makes, one of his rules is that the companies cannot have any leverage, right? I mean, his perspective is leverage needs to be zero, right? It's an extreme view. His logic for that is that he feels that all companies are going to face tough times. Times are good and times are bad. That's just the nature of business. And when times are bad and the business has no leverage, it can play offense. Whereas a highly levered company, when times get tough, which I saw with my dad, who are, just trying to survive and you're trying to keep the wolves at bay. And so that, I think the concept of if you're looking at companies that you want to be around for a long time, to finish first, you have to first finish. Then definitely reducing leverage or eliminating leverage is going to give you a lot of levers that you can pull. Now, I haven't gone 100% down the Polak path, and of course the portfolio takes time to change and such. But it's definitely a very important consideration, much more important than it was before. Where in the past I would say, okay, the market cap is 5 billion and they got 400 million of debt or 500 million debt, and I'd just say, okay, that's fine, and just move on. But I wouldn't ask myself the question: can this business be run without debt? Can they just eliminate the dividends for a couple of years and wipe the debt out? Why aren't they doing that? How do they think about it? Those sorts of things. And I think, I think if you look at companies like Berkshire Hathaway and really the great businesses around, they have architected themselves around that. So obviously, if you lever up a business, you're going to juice the returns, but you also take away the resilience. And this is just one of the points he makes. I think he has many other points. Another interesting point, which I also adopted, is he does not project. He has no projections into the future of what the earnings or cash flows of any of his portfolio companies are going to be. And now that might sound like blasphemy, like how can you run a portfolio without peering into the future? And his answer is that basically it's an exercise in futility because, we are making assumptions. If each assumption is off by 20%, what you have in the end is garbage. You got 4 or 5 assumptions and each one's off by some small number. It's going to create a big error rate. And so, Polak's approach is to buy and hold forever. He views any sell decision as a mistake. And Actually, if you go on his website, they've listed the entire portfolio. They run a hedge fund, it's closed, they don't take new money, but they've listed the entire portfolio, including every exit. And so the whole thing is public. And basically their perspective is that when we're going to go into a business and invest in a business, the holding period is forever. And if the holding period is forever, why are we messing around with DCFs and all that? It's irrelevant. So really good food for thought. Hope you enjoy the book.
Really interesting. Mohnish Pabrai, thank you very much for coming to the Value Perspective podcast.
Oh, it was my pleasure. Thank you very much.